Welcome back to the Deep Dive. Today we'll be taking a fascinating journey into the world of advanced market classification and trend following. You've sent us some really in-depth research on this, and we're ready to extract the nuggets of gold.
It's a fascinating area.
I bet.
Think of market classification as a way to divide the market into different types, almost like personalities based on things like trends and volatility.
Okay.
From there, we can see how various trading strategies perform in each of those market personalities.
So it's kind of like sorting the market into different buckets and then figuring out which strategies work best in each bucket.
Exactly. And the advanced part comes in when we don't just settle for basic categories. We merge and refine them based on actual backtesting results. Imagine taking a basic map and adding layers of detail revealing hidden pathways.
Oh, I see. I see an example in the research where a strategy started with 6 basic market classes and expanded to 11 by merging those with the highest win percentages. That's a great illustration of how this approach can uncover hidden potential. Now, before we get too deep into the weeds, let's touch on the core strategy itself. Trend following.
Yeah.
What is that all about?
Trend following is all about identifying and capitalizing on sustained market trends. Think of it as riding a wave.
Okay.
You catch it, ride it as long as it goes in your direction, and then hop off before it crashes.
Trend is your friend until it's not,
Oh.
as the saying goes. So even when you find a solid trend, you need to be ready to jump ship when it reverses. It sounds like patience is key here.
Absolutely. Patience and discipline are essential in trend following. You're not trying to time the market perfectly. You're waiting for the right opportunity, riding that momentum, and exiting strategically.
Okay, so we've got our market classified, and we're patiently waiting for those trends. How do we put these two ideas together in this advanced approach? Walk me through how we would actually develop a strategy using this.
Okay. Let's break it down step by step. First, you start with a basic trading strategy, something you're already comfortable with.
Right.
Then you define your initial market classes based on specific conditions.
Okay.
For example, you might use the average directional index, ADX, to measure trend strength, and the average true range, ATR, for volatility.
So if we wanted to keep it simple, we could start with just 2 classifications. High volatility and low volatility, right?
Right. You could then backtest your strategy across both of those classes to see if it performs better in one environment versus the other. You'd also want to include a no classification scenario, often labeled as 0-1, to serve as a benchmark.
So you're essentially testing your strategy in different market personalities and in a neutral setting to see what works best overall.
Precisely. The next step is to analyze the backtesting results, paying close attention to the win percentages for each class. This is where it gets interesting. If certain classes consistently show higher win rates, you can merge them to create new, more refined classifications.
It's like saying, hey, this strategy really shines in these 2 specific market environments. Let's combine them into a super category and see if we can amplify those winning results.
Exactly. And this process of merging and refining can be repeated as many times as needed.
Okay.
It's all about finding those combinations that consistently yield the best results for your strategy.
I'm already starting to see the power of this approach.
Right.
Now, the research you sent mentions the importance of having a solid code structure for this kind of strategy development. Specifically, there's talk about the AmiBroker platform and its AFL coding language.
Yes. AmiBroker is popular for backtesting and strategy development, and AFL is its scripting language.
Right.
For this advanced approach, having clean and organized code is vital. You're constantly tweaking and refining their classifications, so your code needs to be easy to read, modify, and adapt.
And there's even mention of a code template where a good chunk of it remains consistent throughout the process.
That's right. The research highlights that about 80% of the code stays the same, providing a solid foundation. This means you're not reinventing the wheel every time you adjust your classification.
Yeah.
You can focus on the unique elements of each classification without having to rebuild everything from scratch.
It's like having a pre-built house where you can easily customize the rooms to suit your needs. Speaking of customization, I noticed 2 key functions in the source code that seem to play a big role in this process.
Those are the getBaseMarketClass and getTradeConMarketClass functions. The getBaseMarketClass function calculates which base class the current market conditions fall into.
So it's basically checking the market's personality at any given moment and deciding which of your predefined buckets it fits into.
Exactly. Then the getTradeConMarketClass function comes in. It determines whether to trade based on your desired market class, the one you want to target, and the current base class determined by the previous function.
So if the get base market class function says, hey, we're in a high volatility environment right now,
Yeah.
and your strategy is designed to perform best in low volatility, the get trade market class function would say, hold on, let's wait for a better opportunity.
You got it. It acts as a gatekeeper, ensuring that your trades align with your strategy and the current market environment. And here's where it gets interesting. Every time you add a new merged class, you need to update the getTradeCon class function to reflect those changes.
That highlights the iterative nature of this approach.
Right.
You're constantly learning, adapting, and refining your system based on the feedback you're getting from your backtesting. Any practical tips for someone who might be feeling a little overwhelmed trying to keep track of all these classifications?
A simple spreadsheet can be your best friend here. Use it to visualize and track your different market classes and their merged combinations.
Okay.
It's a great way to keep everything organized and see the relationships between the various categories you've created.
Okay, we've laid some solid groundwork here.
Yeah.
We've got a handle on advanced market classification, and we've touched on trend following as a core strategy.
Right.
Before we move on, I'm curious about how those formulas play into this whole approach.
Certainly. Let's dig a little deeper into those trend-following formulas and how they can be used to fine-tune your entry and exit points, potentially boosting your strategy's effectiveness.
Okay.
But first, we need to understand the different types of trend-following conditions.
I see from the research that we'll be focusing on point type and span type conditions.
Yes, and there's also a really intriguing technique called point-to-span that we'll explore, which combines aspects of both. But let's unpack those in more detail after a quick break. We'll be back in a moment to delve deeper into these trend-following concepts and how they tie into this advanced approach.
All right, so we're back and ready to unpack these different trend-following conditions. We left off talking about point type and span type. Can we start with those point type conditions?
Of course. Point type conditions are all about precision. They trigger a buy or sell signal at a very specific point in time. Imagine a short-term moving average crossing above a long-term moving average. That crossover point would be your signal.
So you're looking for those clear-cut moments where the market's behavior shifts and you're trying to enter or exit a trade right at that moment.
Exactly. Think of it like a trigger point.
Okay.
However, the research you provided points out that relying solely on point-type conditions can lead to missed opportunities or even false signals.
Okay, I can see how that could happen. What if the market makes a brief, jerky move that triggers your signal, but then it immediately reverses? You'd end up getting in at the worst possible time.
That's one of the potential downsides. Or the market might start trending without actually hitting that precise trigger point, and you'd miss out on the move altogether.
So how do we address those limitations? You mentioned span-type conditions. What are those all about?
Span-type conditions are about staying power. They remain true for a duration of time as long as the condition holds. For example, you might decide to enter a trade if the price stays above a certain moving average for a specific number of bars or days.
So it's less about pinpointing an exact entry or exit and more about riding the trend for as long as it continues.
Precisely. We're not trying to time the market perfectly. You're looking for confirmation that a trend is established and then staying with it until it shows signs of reversing.
I can see how that approach could help to avoid those whipsaws and false signals we talked about earlier. But wouldn't you also risk entering a trend late or staying in too long as it starts to fade?
That's the trade-off. Span-type conditions can be slower to react, which means you might give up some potential profits at the beginning of a trend or take on some losses as it starts to reverse. It's about finding the balance between those two extremes.
The research actually mentions a fascinating concept called point-to-span, which seems to be a way to blend these two approaches.
It is. Point-to-span is a really clever technique that essentially expands a point-type condition to cover a short period of time. Let's say you're using that moving average crossover as your trigger. With point-to-span, you wouldn't enter right at the crossover. You'd wait for the price to stay above or below that crossover point for a specific number of bars or days.
So it's like adding a confirmation period to that initial trigger. You're still looking for that precise moment, but you're giving the market a little breathing room before fully committing to the trade.
You've got it. That confirmation period can help to filter out those false signals and whipsaw moves, giving you more confidence in your entries.
I like it. It sounds like a really smart way to combine precision and flexibility. Now, the research also dives into different ways to implement point-to-span, specifically mentioning static and dynamic approaches.
That's right. Static point-to-span uses a fixed time period for that confirmation window. For example, you might always wait for 3 bars or 5 days of price action above the crossover before entering the trade.
So it's a straightforward rule-based approach. What about dynamic point to span? I'm guessing that's where things get a bit more adaptable.
You're right on the mark. Dynamic point to span adjusts the confirmation period based on other market factors, making it more responsive to the current conditions. One of the examples in the research is using volume as a dynamic factor.
Okay, that sounds really interesting. How would that work?
Imagine this. When volume is high, indicating strong momentum and conviction in the market, you might shorten the confirmation period. You're essentially saying, hey, the market's moving with force, so I'm going to jump in more quickly.
And when volume is low, indicating hesitation or indecision, you'd lengthen the confirmation period, right? You're waiting for more evidence that the trend is real before committing your capital.
Exactly. It's like adjusting your sails to catch the strongest wind. The research even talks about using volatility as a dynamic factor, adjusting the length of the moving averages you're using based on how choppy or smooth the market is.
So in volatile markets, you use shorter moving averages to react more quickly to price swings. And in calmer markets, you'd use longer moving averages to smooth out the noise.
That's the idea. It's all about finding the right settings for the prevailing conditions, allowing your strategy to adapt to the market's ever-changing personality.
Now, with all these different variables and possibilities, it seems like backtesting and data mining are more important than ever.
Absolutely. You need to test different combinations of conditions, parameters, and dynamic factors to see what historically has produced the best results for your chosen strategy and market. Don't just blindly copy settings from someone else. Find what works best for you. There's no one-size-fits-all solution.
This is all starting to come together beautifully. We've got a solid framework for classifying the market, we're identifying those promising trends, and we're fine-tuning our entries and exits using these intelligent trend-following conditions. But I'm sure there are more key insights to uncover, right?
You bet. We still need to talk about some crucial observations and recommendations from the research.
I'm all ears. What else do we need to consider when putting all these pieces together?
One of the biggest pitfalls to watch out for is overfitting.
Overfitting? What exactly does that mean?
It means creating a strategy that's so finely tuned to past data that it fails to perform well in real-time market conditions. You can end up with a strategy that looks amazing in backtests, but falls apart when you actually start trading it.
So how do we avoid falling into that trap?
That's where careful backtesting and a good understanding of statistical significance come in. We need to make sure that our results aren't just due to random chance or fitting our strategy to a very specific set of historical data.
This makes perfect sense. We're trying to build a strategy that can adapt and thrive in the real world, not just look good on paper.
Exactly. And one of the best ways to do that is to make sure you're working with enough data points.
So are we talking about the size of our historical data set, or is there something else to consider here?
It's about the number of trades your strategy generates, not just the size of the data set itself. The research recommends a minimum number of trades per year for reliable results.
Well, that makes perfect sense. If you're only testing your strategy on a handful of trades, it's hard to know if those results are meaningful or just a fluke. What are those minimum recommendations?
For long-term strategies, you'd want at least 30 trades per year. For medium-term strategies, aim for at least 60 trades.
Yeah.
And for those rapid-fire short-term strategies, you'd want at least 90 trades per year to ensure statistical significance.
So the faster you're trading, the more data points you need to validate your approach.
Precisely. It's all about making sure you have enough evidence to support your conclusions. And speaking of trading speed, the research also emphasizes that trend following tends to work better in the long term.
Why is that?
Well, trends take time to develop and play out. If you're constantly jumping in and out of trades, you're more likely to get whipsawed by short-term fluctuations and miss those big, sustained moves that trend followers are looking for.
It's about riding the wave, not getting tossed around by every ripple.
Exactly. And that brings us to another important point. The value of spotting trends early. The earlier you can identify a potential trend, the more profit potential you have.
So we're looking for those subtle shifts in momentum before they become obvious to everyone else. I'm guessing those dynamic point-to-span techniques can really help us with that.
You got it. By adjusting your entry strategy based on factors like volume and volatility, you can increase your chances of catching those early moves and maximizing your profits.
This is all incredibly valuable information, but let's be realistic. Even with the best strategies, we're going to encounter false signals from time to time. How do we handle those inevitable losing trades?
That's where the art and science of money management come in. We need to accept that losing trades are part of the game. The research even suggests that trend-following strategies often have a win rate below 50%.
Wait, really? You can be profitable even if you lose more trades than you win.
Absolutely. The key is to manage your risk on those losing trades, keeping them small and controlled, so that when you do catch a real trend, the gains far outweigh those smaller losses.
It's almost like surfing. You might wipe out a few times, but when you catch that perfect wave, it's all worth it.
That's a great analogy, and it highlights the importance of having a solid exit strategy. Just as we use trend following to enter trades, we can also use it to exit trades. We can set profit targets, use trailing stops, or even incorporate market classification to tailor our exits to the current conditions.
So it's not just about riding the wave, it's about knowing when to gracefully step off the surfboard before it crashes.
Well said. This deep dive has been incredibly insightful. It's clear that combining advanced market classification with trend following can be a powerful approach to trading, allowing you to adapt to different market conditions and potentially improve your results.
This has been a truly fascinating journey. I feel like we've uncovered some powerful insights that I can't wait to start exploring and experimenting with.
I'm glad to hear that. And before we wrap up, let's take a moment to summarize the key takeaways from this deep dive to make sure they're crystal clear for everyone.
All right, let's recap what we've learned in our deep dive into advanced market classification and trend following. We started by talking about market classification, giving the market different personalities, so to speak.
Right. It's categorizing the market based on things like trends and volatility.
And we learned how to take it to the next level, the advanced level.
Exactly. By merging and refining those classifications based on backtesting, it's like revealing hidden patterns.
And we talk about having a solid process,
Yes, starting with a basic strategy and then testing and refining those classifications.
And having a good code structure is important too, right?
Absolutely. You need clean, adaptable code to handle all those changes.
Okay. Then we got into the nitty-gritty of trend following.
Different trend conditions, how to find those good entry and exit points.
We talked about point type conditions and span type conditions.
Each with their own pluses and minuses, and then that really cool point to span technique.
Yeah, that was a good one. And making those conditions dynamic, adjusting to volume and volatility.
It's all about adapting to the market's mood.
Then we talked about overfitting.
Right, making sure our strategy isn't too stuck in the past.
And the importance of enough data, enough trades.
At least 30 trades per year for long-term strategies, 60 for medium-term, and 90 for short-term.
So the faster you trade, the more data you need. Makes sense.
Exactly. And we also talked about how trend following tends to work better over longer periods.
Give those trends time to play out.
Right. Patience is key.
But spotting trends early is important too.
Absolutely. The earlier you spot them, the more potential profit there is.
And even with the best strategies, we can't avoid all losses. That's where money management comes in.
Accepting losses, keeping them small.
Exactly. So those big wins can really make a difference.
This has been a really insightful deep dive, and I feel like I have a much better grasp on advanced market classification and trend following.
I'm glad to hear that.
But before we wrap up completely, I think it's important to leave our listeners with something to think about. We've covered some great dynamic factors like volume and volatility.
Right.
What other conditions or indicators could traders explore when developing their own strategies? What unique approaches can they bring to the table? Remember, the world of trading is vast and constantly evolving.
There's always more to learn and new ways to innovate. So keep exploring and experimenting. And, as always,
Happy trading.